Real estate crash in 2026. Analysis versus headlines. We are going to discuss the news are becoming stronger. We are seeing a lot of headlines these days in newspapers, and headlines, remember, are meant to sell the newspapers. But let's talk in this video about what are the facts and whether there is a crash coming in 2026. So the big reason why people think that the crash is coming is in 2008 there was the last crash, and it's a common notion that there is a crash every 10 years. So we are coming up to the 22nd anniversary of that 10-year mark. That's one. Secondly, the interest rates remain elevated. We saw a bottom of 2% in 2022, and now we are at 6% for a 30-year fixed in 2026. So something has to give up. Remember, the basic of affordability is the ratio of the home value or purchase price to the income in the denominator. So that ratio you always have to keep in mind. So now, first, let's start by defining what's a crash. A crash is a phenomenon that happens in the entire nation almost. Some markets may be less, some markets may be more, because of a systemic issue in the market. It could be over-leveraged properties, extreme supply. So like in 2008, there was an extreme supply, loose mortgage standards. Most people were leveraged to a very high extent. So all of these factors combined, and this was happening nationally because of the loose lending standards. And so the entire market came crashing in 2008. Now we are seeing elevated interest rates. So now let's talk about what we are seeing now. And so there is a difference between a crash, which is widespread, national, because of a huge systemic disorder, whereas corrections are adjustments to the price because of valid factors like insurance rates going up in Sonoma County because of wildfires. The prices will get corrected because nobody will even insure properties in that area. Florida, it's the same thing. Very high insurance rates. Insurance does not want to touch properties, and so lenders will not lend. So that is impacting home values. So local impacts and small corrections of these properties values is what we are seeing in these areas. Whereas in case of a crash, that impact is big. So now let's analyze what's going on in the current market. Before we proceed to what the current market is and how you should think in order to conclude one way or other, please hit like, subscribe, and see if you want to share this video. So the way that it works is that we are not having an oversupply. So when all the builders got burnt in 2008 because of oversupply, they completely clamped down on oversupply. So there is no overbuilding. In fact, we have a shortage of homes if you look at the statistical numbers in terms of the new homes created. Number two, lots of people are currently in the 2 or 3% interest rate. If they want to buy something today, the next interest rate is in the 6 or 7%. So they just cannot afford to move. So they are locked at this point in time. So that's causing homeowners to get stuck in their place unless there is a huge reason for them to move. Number 3, a lot of these homeowners have substantial equity in their homes. Like, because of the high interest rate, a lot of people are buying their homes full cash, no mortgage. So there is no reason for distress in those cases. Secondly, there are a lot of people that have more than 50 or 60% of their mortgage paid down. It becomes impossible for them also to move. So unless you design home ownership properly, see how that freed up equity will work for you. Is that going to advantage you or disadvantage you? Only then you are going to be able to figure out whether you should be moving or whether you should be selling your property. So these are the factors that will come into the play. Now, let's look at whether it is going to be a crash or correction. So, like I have said now, yes, the interest rates are elevated, but the market is extremely strong because of AI and AI incomes. And particularly here in the Bay Area, that strength is extreme, right? So the market is extremely strong. Yes, insurance rates have gone up, insurability has gone down, so that is affecting some of the prices, and you will see some price adjustments based on these factors. But in areas like Bay Area, the incomes are still extremely strong, and so we are not seeing a collapse coming in here in the Bay Area. Not just that, even nationwide, because of the high equity, people locked in due to low interest rate mortgages, they cannot move, they don't want to sell, and high interest rate to make that next move. So people just cannot get out of what they currently have, and that is the reason a crash is very low likelihood event at this point in time. Whereas price adjustments, yes, they are going to happen. So like people are being compelled to move from earlier in 2022 everything was remote work, and now companies are saying all 5 days be back here in the Bay Area or back into your office. So the moment they do that, somebody who was living in Florida now has to suddenly move back to the Bay Area because his remote job is getting more difficult to do or to survive. So in fact, the Bay Area seems to be more poised for appreciation as compared to Boise, Idaho or Montana, where anybody who had gone and bought their 5,000-6,000 square feet houses for 400-300K or maybe 600K at that time, they are all now making their way back into areas where work is. It could be Dallas, it could be New York, it could be Boston, it could be Chicago or Bay Area. So that is going to drive the local markets, and that is what I call it as corrections based on local markets against a sudden systemic crash nationwide. I hope this helps, and if it does, please share with your friends. Like and subscribe to this channel. Thanks for watching. See you on my next one.